All right, everybody, I'm Logan Alec. I'm a CPA. In this video, I'm going to share with you why you should set up Roth IRAs for your children. I'm going to share with you the rules and eligibility requirements for setting up Roth IRAs for your children. I'm going to tell you how I was able to set up a Roth IRA for my son Hunter, who is only 2 years old. And finally, at the end of the video, I'm going to show you right here on my screen, step by step, how to open up a Roth IRA for a child at Fidelity. I'm going to show you on screen me opening up a Roth IRA for my second son, Carson, who is currently 3 months old. So you'll see the step-by-step how to set up a Roth IRA for kids at Fidelity. Fidelity is not sponsoring this video, by the way. It's just out of my opinion. Fidelity is the best option for setting up Roth IRAs for your kids. They make it really, really super easy and straightforward. If you already know all the rules for Roth IRAs for kids and you just want to jump to that walkthrough, right, in Fidelity of actually setting up a Roth IRA for your child, check out the table of contents in the description below. It will tell you exactly the timestamp that you should go to where the walkthrough portion of this video begins. So if you're a parent of a minor child or a grandparent of a minor child, or you're an aunt or an uncle, or you just know people who have minor children, watch this video, apply it to your own kids. If you don't have kids, or you're past a child raising stage of life, share it with those you know who do have children still living at home, because this strategy I am sharing in this video can literally make that kid a millionaire later on down the line, and I'll show you the math later in this video. But before we get into all the details here about Roth IRAs for kids, let's talk about IRAs in general. As most of you know, the traditional IRA gives you a tax deduction now for your contribution if you're eligible to take the deduction. So you save money today on taxes, but you will pay taxes in the future on the distributions out of your traditional IRA when you start taking them as early as after age 59 and a half, or when you have to start taking them at the age of 72, or whenever the required minimum distribution age is in the future. The Roth IRA does not give you a tax deduction for your contributions today, but the earnings grow tax-free. So when you take withdrawals out of your account, right, after age 59 and a half, if you so choose, or whenever you want, those distributions are not taxable. So you've enjoyed tax-free growth in that account for potentially decades. And as of right now, there are no required minimum distributions from Roth IRAs. You can set up these IRA accounts very easily online, both traditional and Roth. The hardest part is really deciding which one to contribute to, right? A traditional IRA or a Roth IRA. And if you've seen my video comparing the two, link at the top of the screen and in the description below, you may have a pretty good idea, but the basic rule of thumb is that the further away you are from retirement, the further away you are from needing to tap into your retirement accounts, and the lower your tax bracket right now, the more attractive the Roth option, generally speaking, is. Check out that video I mentioned for a more in-depth look at traditional versus Roth IRAs. A link to it is in the description below. The Roth versus traditional analysis can be a fairly tough decision, for high or high-ish earning mid-career professionals, right? I made a video recently on 15 Roth IRA warnings, link at the top of the screen and the description below. But if you're a child who is as far away from retirement as anybody, and who is probably in a very low tax bracket, if not the 0% tax bracket, the traditional versus Roth decision is easy. Go with the Roth. The tax benefit of a child contributing to a traditional IRA would be minimal, right? Given their low and possibly 0% tax rate if their income is less than the standard deduction amount for federal and state income tax purposes, right? They'll still get tax deferred growth, right, in the traditional IRA, but they won't get that significant tax benefit of the traditional, which is the tax deduction for the contribution, because they don't pay taxes anyway, because their income is so low. They don't get a benefit for that deduction, right? The Roth, on the other hand, we don't get a deduction anyway, will give them decades and decades of tax-free growth. No, they don't get a deduction today like they would with their traditional IRA, but like I said, what are they going to do with that traditional IRA deduction anyway, if they don't even have a current year tax liability? So the Roth is generally the better bet for children. It is an extremely powerful investment vehicle for young people, and especially for children and older people as well in the right circumstances. In fact, a Roth IRA can make your kid a millionaire, and here's the math. Let's say your child makes $900 per year at age 9, okay? So that's $75 per month, or about $17 a week. That's basically babysitting money, right? Or dog walking money, right? And let's say they put that money in a Roth IRA. Then let's say your kid makes $1,000 for the year at age 10, and then $1,100 for the year at age 11, and so on until $1,800 a year at age 18, contributing all of these earnings into his or her Roth IRA. Oh, and by the way, I know what you're thinking. I know kids, like, are they really going to want to put the money in the Roth? No, it's okay. They can spend it, right? They can do what they want with it. And you can fund the IRA right? Just as long as you don't fund more than the amount of money they earned during the year, okay? Then let's say that your child never contributes to a Roth IRA again after the age of 18. So at the ripe old age of 18, they are completely done contributing to their Roth IRA forever. Assuming they let the money sit in their account, invested, growing at an average annual return of 8% growth per year, okay? And 8% is probably not unreasonable, assuming that the Roth IRA could be invested quite aggressively, right, earlier on in life, and they're starting very young. Then by the time they're 6 years old and eligible to withdraw money from the Roth, right, because they would be at least 59 and a half at that point, assuming the tax laws don't change, they would have over $1 million in their Roth. And that's at age 60, okay? That is assuming they never contributed to a Roth IRA ever again after the age of 18. Let that sink in for a second. Over $1 million at the age of 60, okay? Which in 50 years will probably be considered relatively young, right? Not even including the money they contributed to the Roth over the course of a 30, 40, 50-year career. They end up with over $1 million, okay? Their total contributions between the ages of 9 and 18 were only $13,500, but it would grow over the decades to over $1 million tax-free. That is the power of compounding. That is the power of tax-free growth. That is the power of the Roth IRA. So you see why I get excited about this, right? And even if my 2-year-old Hunter, he currently has a little over $2,000 in his Roth as of the time that I'm recording this video. If we never put another dollar into his Roth, and if Hunter grows up and goes his whole career without dropping another dollar into his Roth, and he only has $2,000 in it now, but that $2,000 grows at an average rate of 8% per year in the stock market, he's going to have over $200,000 tax-free in his Roth when he's age 59 and a half, when he'll be eligible to take money out, assuming Congress doesn't change things. If he waits until he's age 70 to start tapping into his Roth, he'll have $480,000. Right? How much that could actually buy at that point? Well, that depends on the Fed, doesn't it? Obviously, $480,000 then will likely be worth less than it is today, but it should still be a tidy sum. But here's the catch, right? To contribute to a Roth IRA, or a traditional IRA for that matter, your kid or anybody needs earned income, okay? So your maximum contribution to an IRA is the lesser of the statutory limit for the year, which right now is $6,000 for those under the age of 50, or your earned income. There is the spousal IRA strategy for those who are married, right? But this video is about Roth IRAs for kids. I'm assuming your kids aren't married. Bottom line, your kid needs to make money in order to contribute to an IRA, whether traditional or Roth. However, the definition of earned income is very broad. It doesn't mean your kid needs a full-time job or to work the maximum number of hours they're allowed to work at their age. If your kid gets a modeling gig, right, and earns the money from that modeling gig, that's earned income. You know, put that money right into a Roth IRA and let it grow tax-free. Or if your kid does yard work around the neighborhood, or babysits, or walks a neighbor's dog, I don't know, could be anything. How are we doing it right now, right? For our young children, how are we generating a little bit of money for them, a little bit of earned income for our kids so they can contribute to a Roth? YouTube. If you watch my video on how much money small YouTubers make, you know that my wife and I have a family vlog right here on YouTube just documenting our daily life called The Alec Family. This family vlog makes a little bit of ad revenue from YouTube, and we're taking a portion of this ad revenue and paying it to our children as our employees. I think this is reasonably conservative. It would obviously be quite aggressive for my business, to pay all the ad revenue to the kids, right? Because on the kids' earnings, I get a deduction, right, in my business at my higher tax rate, and this money is tax-free to them, right, because they make less than a standard deduction. So any money the kids are paid is essentially shifted from my high tax rate to their literally 0% tax rate, right? So saying 100% of the ad revenue from the family vlog is theirs is probably a little bit too aggressive. So we've landed on a portion being considered the kids' compensation, and I think that's fair and not too aggressive tax-wise because, look, this isn't just, for a tax thing only, right? No one would watch the vlogs if the kids weren't in them. So I think it's economically reasonable as well. Now, you savvy ones out there, you heard me use the E word. The E word being employee, right? Making your kid an employee of your business. My kids are employees. And you're thinking, employee, Logan, don't you have to pay FICA taxes on your kids' wages? You actually don't, right? If you do it the right way. Because if we look at the tax code here, I'm looking here in the Internal Revenue Code, that's tax code, Subtitle C, Employment Taxes, Chapter 21, Federal Insurance Contributions Act, that's FICA, Subchapter C, General Provisions, Section 3121, Definitions, where it defines wages for purposes of the FICA tax, that's the Social Security Medicare tax. And if you look at the definition of wages, it says for purposes of this chapter, the term wages means all remuneration for employment. Remuneration for employment, But then if you look down here where it defines employment, it says the term employment shall not include services performed by a child under the age of 18 in the employ of his father or mother. So that means that remuneration paid by father or mother to their employed child, their own employee, is not subject to FICA taxes. And you might want to check with a CPA in your state, but in my state, California, if I look at the California Code on unemployment insurance withholding, it uses the same language as the Internal Revenue Code. It says employment does not include service performed by a child under the age of 18 years in the employ of his father or mother. Okay, so basically, I don't have to withhold anything for IRS. I don't have to withhold FICA for California either. Now wait just a minute. My business is an S corporation, right? I mentioned that in previous videos. Google/YouTube pays my S corporation. Here's where it gets tricky. Because my S corporation is not me, the code doesn't say that employment for FICA tax purposes doesn't include service performed by a child under the age of 18 in the employ of his father or mother, or in the employ of a business owned by his father or mother. All it says is employment for FICA tax purposes doesn't include service performed by a child under the age of 18 in the employ of his father or mother. So I take that to mean that in order for me to qualify for this exception, or for my children's wages to qualify for this exception, they have to be paid not by my S corporation, which filed its own tax return, right? It's a regarded entity for tax purposes, but rather they have to be paid from me directly, right? Through a business that is disregarded for income tax purposes, right? Such as a single member LLC that hasn't elected to be taxed as a corporation or a sole proprietorship. The income and expenses, both of which would be reported on my wife's and my Schedule C attached to my Form 1040 tax return, or Schedule E if we were talking about rental properties here. So and it doesn't have to be an LC, right? You can do a DBA. So what I've done is set up a DBA management company, okay? And my S corp pays a management fee of sorts to this separate sole proprietorship business, and the kids are paid out of that, right? So I set up a separate business, not an LLC or anything, just got a DBA, got that DBA business's own business bank account. So my S corp pays that business, which is basically considered the same as me for income tax purposes, unlike the S corporation, right, which is a separate entity that files its own tax return. And that business pays the kid out of its business bank account. And this other business reports its income from my S corporation, right, on its own Schedule C that is attached to my 1040. And then it shows the payments to the kids on the Schedule C. So in that way, the payments to the kids will be considered to be from their father, right, and therefore qualify for the FICA tax exemption. So think about the bookkeeping here, right? My S corporation, Alec Media LLC, gets a deduction for the money paid to the management company. So there's a deduction for me and my business at my high tax rate. It's a wash at the management company, right? Money in from the S corp, money out to the kids, right? Might calculate the revenue as a little bit higher to as not attract IRS attention, right? But then basically that company gets a deduction against, that revenue. It gets a deduction for the money paid to the kids, right? So essentially I've created a deduction at the S corp level, which flows through to me at my high tax rate, right? The Schedule C is essentially a wash. Yes, the kids have income for income tax purposes, but because their income is below the standard deduction amounts, both for federal income tax purposes and state income tax purposes, they receive this income tax free. Not only does my business get a tax deduction, right, and the kids get tax-free income, but now my kids have earned income and they can contribute to a Roth IRA for tax-free investment growth so they can become Roth millionaires one day. So what's the takeaway here to make your kid a millionaire? Start a business and pay your kid and have them contribute those earnings to a Roth IRA, right? It doesn't have to be your business. They can go get a job somewhere or do some gig work somewhere. And keep in mind that they can spend the money, right? And you can still make the contribution for them with your own money as long as your contribution doesn't exceed their earned income or the statutory limits for the year. Do that year over year, and your kid will very likely have a 7-figure nest egg, right? On top of what he or she puts away throughout the course of their adult life for retirement, and on top of Social Security and all that. It's great. It's an awesome strategy to build wealth for your children from an early age because of the power of tax-free compounding over time. Now, if your kid is making money outside of your own business, they don't have this FICA tax exemption, right? So one thing you have to keep in mind is the self-employment tax, which kicks in if your kids or anybody's net self-employment income for the year is $400 or more, right? So you got to keep that in mind. Your kid does a modeling gig, makes a few, $100, let's say $1,000, I don't know. Sure, they're still under the standard deduction amount, but they would still have to file a tax return and pay the self-employment tax if their net income from self-employment is at least $400. However, If you pay your child as an employee from your own business, like I do, and as I just described previously in this video, your kid can't escape the self-employment tax because they're not self-employed, right? They're your employee, and you can escape, paying FICA taxes on their wages, as I just walked through. So where can you open up a Roth IRA for your kids, also known as a custodial Roth IRA? A few places, actually. You can do it at the big online brokerages, Schwab, Vanguard, Fidelity. I looked at Schwab's page about custodial IRAs. It looks like you'd have to call them at 866-855-5636 or download an application. So that's an option, but it doesn't look like they make it super easy. I know you can set up a custodial Roth IRA at Vanguard, but I couldn't really find a dedicated webpage for it. So that brings me to Fidelity. Fidelity has a dedicated webpage for opening up a Roth IRA for kids online. It's literally fidelity.com/retirement-ira/Roth-IRA-kids. I don't have to call anybody, right? I already have a few accounts at Fidelity anyway. This is where I set up Hunter's Roth IRA. So right now, I'm going to pop behind my computer, and right here on screen, I'm going to set up my son Carson's Roth IRA here on the screen. You can follow along with me so you know how to do it as well. It's going to be super easy. So right now, I'm going to hop behind my computer and walk through setting up a Roth IRA for a child in Fidelity. And Fidelity is not sponsoring this video, by the way. I just personally like them for Roth IRAs for kids. So I'm going to hop behind my computer now. All right, folks. So I'm here at fidelity.com/retirement-ira/Roth-IRA-kids. This is the current URL to open a Fidelity Roth IRA for kids. So very simple process. There's some basic information here, right? We've talked about this stuff already. Obviously, if this is for kids, that means someone under the age of 18. They must have, compensation or earned income. Maximum contributions can't exceed their earnings. I discussed that previously in this video, and the maximum is $6,000 per child for this year. So, all right, let's go ahead and open this baby up. Open Roth IRA for kids. So, I am already a Fidelity customer, so I'm just gonna log in here with my username and password. If you are not already a Fidelity customer, you would select no, obviously, and then you would just create an account here, right? Easy peasy. I'm going to click preview the process just to kind of show you what they're going to ask you about, right? Just very basic information. But I'm already a Fidelity customer, so I'm going to put my username and password here. Here we go. So now this minor owner, this is the information about the minor, right? Now, if you don't have a Fidelity account already, then there might be a screen before this to input more information about yourself, but Fidelity already knows me, right? So I didn't have to do that. But here, where it says minor owner information, this is information about the child, right? Your child that you're setting up this account for. So I'm going to move me, or should I move me? I'm going to move me right here. So I'm going to fill this out for my son. Okay, make sure you get this right. Make sure you get all this information right. Minor owner, U.S. citizen, yes. I am a parent. My phone's vibrating. All right, so this is basically just the state where you live. So, assuming you all live together. All right, the address. This is blurred out, but this is just my home address is here because Fidelity already knows that about me. All right, next. Okay, so review and confirm. All right, so obviously I am the custodian of this account. That's why my name is here, identified as the account owner. And it has all, a bunch of my information here that Fidelity already knows about me because I already have an account at Fidelity, right? It has my employment information because I already have an account in Fidelity. Fidelity already knows stuff about me. And then here's the minor information here, right? So when my son Carson turns 18, right, this account will be transferred to him, and he will have control over it. I will no longer be the custodian of the account. 18 is the age in most states. It is the age in my state, California, but you probably want to check about your state to see what that age is in your state. Most states, it's 18. Some states, it might be a little older, 21 or something like that. Okay, and then down here, account settings. Let's talk about these real quick. So, core position. This is where your money is held until you invest it, right? So you're going to fund this IRA for your kid, and before you buy stocks or ETFs or whatever you're going to buy in the Roth IRA for your child, it's going to be held in cash, right? It's going to be cash in your account. I don't typically care too much about this, right? Because I'm going to invest, every penny in the kid's Roth IRA, right? But you can change this if you'd like, and I guess I'll walk through that just to kind of check this out here. So looks like you have two choices here: Fidelity Government Money Market Fund or the FDIC Insured Deposit Sweep Program. I'm just going to look to see if one has like a higher interest rate than the other. Let's see here. Okay, so it looks like for this one, the FDIC Insured Deposit Sweep Program Disclosure. Okay, here we go. Interest rates. Interest rate paid on your program deposit will be set on your set point. Okay, current rates you can find at fidelity.com/IRA core rates for IRA rates. Okay, so let's put that in here. Okay, so the interest rate is like astronomically low, right? I mean, 0.01%, like whoop-de-doo, right? And I'm sure the other one isn't that much more. Let's or it might even just be the same. So let's look at that. Okay, SPAX, SPAXX. Okay, yeah, so we're looking at, well, actually, okay, this is actually a little bit higher, right, than the other one. So I'm gonna go with that one, even though I'm not keeping, my son's Roth IRA in cash. I'm gonna be investing the money in there. So I'll keep it at that. And then this is email preferences. Do you want to receive the documents electronically? I typically say yes. I don't like getting mail. I don't like getting sensitive stuff in the mail. I mean, I like getting mail, right? Like packages and stuff, but like I don't like getting these documents delivered in the mail. I'd rather get them electronically. Okay, so I'm going to save those settings. And that's basically it. Then I'll hit confirm my information. And then of course there's these disclosures that you're going to want to open up and read. I know you're not really going to read them all, but I should tell you, right, you probably want to read this information. I've kind of gone through these before when I've set up the IRA for my first son Hunter. But you might want to look these through. If you know what a Roth IRA is, you won't be shocked by anything in those documents. So let's just say that. Okay, do you agree to electronic delivery of the above documents? I'm going to say yes. And then by selecting open account, you acknowledge that you are the person named in this account application. You provided with the above documents electronically, do not need a paper copy, et cetera, et cetera, et cetera. Okay, so now I'm going to click open account. Okay, so great. The account is now open and ready to fund, right? It says your account number here. I've obviously blurred this out because y'all don't need to know the account number. And I'm going to set up a one-time transfer from bank account. I'm going to hit continue. All right, so now I'm just going to select the account right, that the account that I use to transfer money from, the management company to the kids' IRAs, right? So that's already linked because I've already done this for Hunter, my older son. All right, so where will the money be transferred? It will be transferred to this one. This is the Roth. Yep. Okay, this account isn't currently connected to the bank you selected. Link your bank to this account. And obviously, if you're new to Fidelity, I think, what would you do? You'd select link a bank to a Fidelity account, right? Because you don't have an account linked to Fidelity yet, right? Because I'm already a Fidelity customer. I already have this account linked in Fidelity. It already knows about this account, right? So I have to click link your bank to this account because this is obviously a new Roth IRA. So I'm going to click link your bank to this account. Yep, link account. Okay, and now I'm going to continue to transfer. So, I've already kind of allocated, right, the, projected earnings this year, right, for how much I can allocate, to Carson of the family vlog income. But I'm not going to do that full amount now. I'm just going to basically just transfer $100 just for the sake of example here, right? And then, obviously you would transfer, right, whatever amount you calculate. Your child can contribute to a Roth this year, right, based on their earned income, up to the current year limit, which in 2021 is $6,000. All right, so I'm just going to do $100 and hit continue. Okay, so one last step before submitting your transfer is just obviously reviewing the details of the transfer. Everything looks fine to me, so I'm going to hit submit. And then it's been submitted. And that's basically it. Then when the money's in the account, you can log in and make trades in Fidelity in the account, just like you could in any other account in Fidelity. How to do that and all that is probably beyond the scope of this video. I am planning on doing a separate Fidelity review, right, where I walk through the Fidelity platform. Hey, here's how you make a trade. Here's how you change your settings and things like that. I hope to do that review in the next couple months here. It's pretty self-explanatory, but something along the lines of the reviews I've done for like Webull and M1 Finance and things like that. So anyway, that's how you set up a Roth IRA for a child in Fidelity. All right, folks, so that's how you set up a Roth IRA for your child. You would obviously have to walk through this process and set up a separate Roth IRA for each one of your children who have earned income and for whom you want to set up a Roth IRA for. But as you can see, it's pretty simple and straightforward. You got to keep in mind the rules I mentioned in this video, right? But if your child has earned income, I would strongly recommend you consider having them fund their Roth IRA up to the lesser of $6,000 this year or their earned income, right? Or of course, you could fund the IRA for them up to the amount of their earned income or that statutory limit, whichever is less. Thank you so much for watching this video, everybody. I really hope you found it informative. If you did, I would really appreciate a like on the video down there. Give me a big old thumbs up and be sure to check out my other Roth IRA videos right here. I give you 15 Roth IRA warnings. Also check out my video down here where I compare traditional IRAs to Roth IRAs, and I'll see you in those videos, everybody. Bye-bye.